I would not build a business model like Atlassian's because Atlassian's numbers like didn't do that. It was not a company that did the triple, double. It kind of, it didn't exactly look like a turd because it was sitting off free cash flow. But when you're at 20 or 30 or 40 million of ARR and only growing 50%, that is not a super sexy company by then standards, but certainly by today's standards.
Jay, welcome to the podcast. Thanks for joining us.
Yeah, thanks for having me.
Cool, Jay. I've really appreciated just like learning from you over the years. Really grateful that you're taking time with us to do this today. I think like Atlassian in particular is a great place for us to start. It's like one of these companies that I think so many people have heard of, but not everybody has been exposed to like all of the particularities that made it so special. So yeah, I would love to start talking there with you. One of the things that I think is noteworthy that I'm curious to hear your take on is it seems like Atlassian has always had this real focus on efficiency. And I think whenever you talk to anybody from Atlassian, whether they're in the like go-to-market org or you talk to leaders from product as well, everyone seems to really think about sort of the efficiency metrics. Like how are we acquiring customers? How is it going to scale? Obviously, Atlassian sort of famously didn't need to raise primary capital. So I'm sort of just curious to hear from your vantage point, like what was that? Like what made Atlassian different than so many other companies that were all on sort of the VC treadmill?
I think it was a byproduct of when the company was born. The company was born after the dot-com crash in 2002, and also it was in Australia. Two developers, that I think dropped out of their last year of college and wanted to start a company together, or at least did so immediately after finishing school in Sydney, building tools for developers, targeting, effectively open source as a competitor. And so they weren't going to charge a lot of products. It wasn't really a fundable proposition at the time. And so I think a lot of the focus on efficiency and leverage and just thinking about scale was just born out of necessity, right? It was probably couldn't have raised venture capital had it wanted to. And so it was bootstrapped. And when you bootstrap, you're funding the business from the cash register. And so you're thinking every dollar that I've earned, I'm going to figure out thoughtfully how to invest that dollar in future dollars that I can earn. And so I think the company was just wired that way. It was a pretty frugal place, but frugal in a good way, not a bad way. Although, I was there for 12 years. The first 8 years, I flew coach to Sydney every time I got, like the whole company did, because it was also a very, very egalitarian place. We were, we were all in the same boat. I think there was no kind of levels or hierarchy. And so if anyone was going to fly, business class, the whole company was going to fly business class. And so we were all kind of in it together. But I think we spent the company's money as if it were our own, and as if it were hard earned, because it was.
I'm curious about how it impacted like the way that you thought about building go-to-market. It's almost hard for a traditional venture-backed Silicon Valley company to think about, because in so many ways we're all thinking, well, I can raise this much, and so I'll have this burn ratio where I'm going to add this much ARR for this much burn. And, so we even had these concepts that don't even apply. You must've been thinking in different metrics to even work that way. I'm curious, like, how did you sort of orchestrate the go-to-market teams as you were building in these like super efficient ways?
Well, by the time I joined in 2008, it was already profitable. So it was generating free cash flow from the quantum of customers that it was acquiring at the ACVs that it was acquiring those customers through. And so then just the question is, well, how big is that market for us to go? Do we need to change anything, or is just the TAM big enough for us to, continue adding features to that business model and figuring out how to scale? And that's what I came in to do. But the bulk of the business was operating successfully. And so, the thing that we always heard was, hey, it's cute. Your business model will scale to 5 million of revenue or 10 million of revenue or 20 million of revenue. There's no way it gets to 50. And then when we got to 50, it was like, there's no way it gets to 100. And there's no way it gets to 5. And there's always sort of like, this hypothetical barrier that we would smash into and then have to change. And that was the counsel that we always got, I think, just because nobody had seen a business model like ours just continue to scale. And so, that was like, the job was, how many customers can we go get at these price points? And also, like, what does winning that customer provide us in the future? Like, what does that give us a future opportunity to do, to sell them more product, to expand them, with higher value SKUs, kind of additional things that, that we could sell them over time. And, we just believed that the hardest thing for any company to do is acquire a new customer. Oftentimes expanding that existing customer or selling them additional things is easier because you've built a relationship. Presumably you've given them a lot of value, and they value the relationship in exchange. And so if there's other things that you can provide them, that deliver value, they're probably going to look to you to provide them. And that was the belief. The hardest part about building the foundation of this truly product-led growth, product-led selling engine, that we built and scaled, was just that nobody had done it like we had, or it scaled it to the point that we had. And so it's, there's always some anxiety around that. When you're first to, I always love to use that penguin, the penguin metaphor, where, the penguins that sort of like hang out in the tip of the ice, and, they huddle, and there's sort of safety in numbers, right? Which, by the way, I think is, if I draw kind of a through line on business models, part of the reason that you see business models that all look the same is because everybody's done it before, and it's sort of a tried and true playbook where, in sales and marketing, the very traditional B2B selling motion, everybody does it. So it's sort of a, it's easy to kind of like be a penguin that hangs back in the pack. And I think we were, that first penguin that kind of jumps off the edge. And, two things happen to that penguin. Either they're the first to get eaten by a shark, or that they fill their bellies full of all the fish that the rest of the penguins didn't jump in. And, fortunately, we got the latter, not the former.
That's funny. Yeah, I think I've heard that they kind of like knock one penguin in on purpose to like, test the waters a little bit.
Yeah, maybe that's what happens. Yeah, the sacrificial penguin.
So I guess, do you think, because it's an interesting question of like, I guess you built it this way with sort of, we're going to play for the very long term. We're not going to race to it. And we're just going to believe that this will keep compounding, partially because, as you sort of described, like that was sort of just the option in front of you. I guess the two questions that are going through my mind here are, if you had wanted to grow way faster, if you had raised a ton of VC in 2008, could you have grown way faster? Or actually, were you growing pretty near the natural rate? And looking back, do you think that in many ways this was the healthiest thing you could have done?
No, I'm sure we could have grown faster. The thing that we deferred is, we deferred any focus or commercialization of the most valuable segment for B2B, which is the enterprise segment or upper mid market. And we were selling into that segment. And so, we had, I don't know, 75% of the Fortune 500, but they weren't spending a lot of money with us. And, that was sort of like the part of the equation that anyone that looked at the business would say, you're doing it wrong. Like a big company like Boeing should be spending millions of dollars for software that thousands of people in their organization use on a daily basis. Like, you're leaving way too much money on the table. And by the way, we knew that. And so, but, serving that segment requires a different level of investment in product and a different level of investment in go-to-market. We would have had to have built out, a proper sales organization. And by the way, with that sales organization comes a proper SE organization and enablement and training and sales operations and, a legal contingent, because we'd be doing a lot more hand rolling of agreements and kind of relationships with big strategic customers. Our product roadmap would probably, need to be more attentive to, what big customers needed, that the sales organization would tell the product organization, if you don't do these things, we're not going to win these deals. Like, we didn't have any of that. And by the way, that was a deliberate, intentional choice. That, what we believed was, if we landed inside of those organizations, we would preserve a future opportunity, to tilt the commercialization, more in our favor. We were providing way more value for the customer than we were getting back. But it also meant that we just didn't need to invest in parts of the business that needed to support that growth. Part of the anxiety, we felt, is we were a company, that was growing, at somewhere between 40 and 60%, well shy of 100 million in revenue. even by today's standards, or certainly by standards back then, we wouldn't have looked like a very attractive growth company because we weren't at 50 million, almost doubling, going from 50 to 100. And by the way, there are competitors in our market that were, and those competitors were doing the exact opposite of us. They were selling, C-suite on down. They were knocking on the doors of the global 2K. They were trying to convince, a C-level executive to spend millions of dollars on software that would transform their organization. A lot of like big solution selling and value selling. And here's all and discovery of pain inside of those big organizations that they could map to what their software would bring, like very typical. And so it caused us anxiety when you saw them kind of race by us, where we thought, man, are we doing the wrong thing? And I think we recognized that we couldn't have built, like Atlassian wouldn't, eventually had to go access that customer segment and that part of the market and participate in the value that we were bringing those customers to become what is now, a $40 billion, market cap company. It wouldn't be that without it, but it was the way that we prioritized getting it and the way that we actually landed it and then preserved a future expansion and kind of upsell motion for ourselves without competition, I think was, kind of the strategic unlock for the way the company was built.
Hey, we'll continue our interview in a moment after a word from our sponsors.
Are you building a business? Well, if you haven't already been asked by potential customers or investors about SOC 2, ISO 27701, GDPR, or HIPAA compliance, you will be. Achieving compliance can unlock major growth for your company and build a foundation of trust, and Vanta can help. Vanta automates up to 90% of compliance work, getting you audit ready in weeks instead of months, and saving you up to 85% of associated costs. Vanta scales with your business, helping you successfully enter new markets, land bigger deals, and earn customer loyalty. Bonus, for our 1 to 1,000 listeners, you get $1,000 off Vanta. Just go to vanta.com/1000. That's VANTA.com/1000.
Maybe one last question on this topic. I'm curious now, as you think about your time at Atlassian and you now reflect on your own work as an investor, and you think about some of the benefits and some of the downsides of the way you did things, and then you think about the companies you work with today, or you just reflect on the ecosystem at large, do you think that companies are raising too much capital too often and would be better served, not from a dilution perspective, but even just from a operations perspective, by maybe not raising nothing, but doing something closer to Atlassian? Or do you think that Atlassian was for some reason a unique case and it's not something for most, tech companies to emulate?
I think, it's always situational. It depends on, the company and the market segment they're in and what they're going after and how they're going to do it and what it'll take. I mean, certainly there are examples of companies that are bootstrapped or haven't raised a lot of capital. I invested in one called Browser Stack. I'm on the board of one called Zapier. There's examples. I think they're rare, more rare than otherwise, because it's a different type of challenge and a different way of building a company. And I think the trade-off is potentially slower, more durable growth, more durable long-term growth. The segments that you sell into and how you want to win in those segments. And there could be a version of history that is written where those companies that went top down starved Atlassian's ability to kind of win in those markets. And every company that did $1 million deal with that competitor kicked Atlassian out, and we never got it back or something. And that isn't what happened, I think, because the other thing that you had to do is we had to build a product that part of our strategy depended on building a product that actually generated user love, which is probably a strong statement to say about Jira, but it exists. There are people that really love to use it, and when it's configured right, it can make a big difference inside of companies. And so we had kind of user pull. We were trying to win the hearts and minds of people for whom they would be the primary users, and that isn't always true in top-down selected enterprise software, where somebody's made a big decision and then they've spent $1 million on a big purchase for part of the organization that really didn't vote. There was sort of some small group of people that maybe selected it. And then all of a sudden you're like, man, why are we using this? This is kind of awful. And anyway, I mean, so it kind of depends. I do think that, the thing that we learned, that sort of, I think, frugality point and, and an orientation, really thinking about where the money would be invested and what return we could produce with that investment. That was a deep discipline. I don't think that exists everywhere. I mean, by the way, it does exist in companies that raise venture capital too. I mean, I've got a bunch of them that I've invested in. And so it's hard to say like one thing looks like this and another looks like that, because obviously, both approaches produce great outcomes in businesses. A lot of this boils down to just really good execution and strategy and one foot out of the, building a company is hard, whichever way you do it, whether, you've raised capital from investors or you've bootstrapped yourself, the things that you need to do are just tough. And there's lots of great examples of companies that have raised capital and stubbed their toe on different things and didn't quite execute right. And there's lots of probably examples of companies that bootstrapped and didn't quite get there because they weren't aggressive or ambitious enough.
To that end, when you do something different and you're successful, it's hard sometimes to disentangle whether you're successful because of it or successful, in spite of it, or if it was neutral. And you guys did a lot of things differently. We'll get to that. Jack just asked about fundraising, but I'm curious if we could reflect on some other areas where you feel that you guys are the exception to the rule. And you say, when companies are asking you about your case study, you say, hey, I wouldn't necessarily do it like we did it. Something unique that Atlassian did that more companies should emulate, whether it's multi-product or from the get-go or other things that you feel that unique to what you guys did that more companies should emulate or they should not emulate. I.e., it was an exception to the rule.
Yeah, well, I mean, I'm biased, but I think there's if you've got a big enough market, I mean, a lot of what Atlassian was able to construct in its strategy hinged on the fact that our TAM was big, right? And so really, and if you look at how many customers Atlassian has, I mean, it measures its customer base in the hundreds of thousands of like real legitimate, usage. If you've got a TAM that big, then I think you need to be thoughtful around the construction of your business model and how you want to go after that. And by the way, the other things around the business model. And so, I've talked previously about, we thought a lot about just building economies around the company. And, we built, a services and reseller channel that was like this third-party economy, helping sell our products into more complex environments, but also implement it around the world and removing friction from the buying process where we didn't support local language or currency or a bunch of things that just made it hard for the customer to come to us. And that meant that there were hundreds of these small little companies all over the globe that were hiring people inside of their business that would be dedicated to our business. And so that's a hugely, virtuous and valuable thing to kind of build around your company. Hard to do, takes a lot of time, especially if you're building, a direct selling motion where you're like, well, I'm going to remove that friction myself. I'm going to sell in all the foreign currencies. I'm going to sell in all the languages. I'm going to do all the things. You'll never build, sort of an indirect thing that can maybe complement you because you do it directly. We built an ISV kind of app ecosystem around the company. And so, publishing, documenting and publishing all our APIs and sort of being first class about like how people could extend our products, and then building a marketplace where our customers could reach into that ecosystem and buy things, through a singular marketplace. That takes a long time to do and a lot of energy, and those seeds basically you have to water for a long time before they pay off. But again, huge defensive moat around the company, because I don't even know how many add-ons most Atlassian customers have, but it's probably measured in dozens. And so in addition to being a little stickier because they've surrounded our software with other software, there's this whole vibrant economy of companies that are again making money, and individual developers or small companies that are that are making money on top of our platform. The customer community, again, we worked really hard at building a credentialing system so we could train people on how to become a Scrum Master. Or, we believed that having Jira in your title in your LinkedIn profile would be a recruitable feature. And that proved true. And so we put a lot of energy into training programs and certification programs. And then, building customer community programs where people could find each other. So I mean, and again, I think all of those things, if we had a small TAM and we measured customers in the hundreds, those things wouldn't make a lot of sense to do. You do other things to get those customers, but I think that's sort of the main takeaway is if your market kind of looks comparable to ours, and you've got you could imagine your software being in hundreds of thousands of places. I think those things are worth building. They're hard to build, but they are worth building.
Yeah. Okay. So I'd love to poke on that. So hopefully, as many founders as possible, I think either want to be in or are in or have some plan to get into a massive TAM. I think certainly that's the goal for all of us. So assuming that you believe you're in a sufficiently big TAM, I'd love to talk about some of the tactics that help you get to these places of real dominance. A couple threads that I think are interesting to pull on here. One is Atlassian's pricing. I remember when Lattice got started in 2015 and we were looking at some other software companies, what could our pricing be? I remember looking at Atlassian's website at least then and being oh my God, you can get 10 seats for $10 total, or, really had these low barrier to entry prices. Obviously also, you've talked about the fact that there were all these integrations. And so there was this sense in which you're going to get in cheaply, you're going to get hooked through these integrations. So I guess I'm curious to pull on perhaps those two threads first of for a startup that's trying to get to some amount of ubiquity in their market, or a startup that's trying to get some real lock-in. Can you share some of your thinking around pricing and ecosystem in particular?
Well, I'm a big believer in better, faster, cheaper. And I think, if you can be all three of those, it is a hard combination to beat. I think if you're not all three, there's a vulnerability that some competitor or alternative can attack. And sometimes that thing, will win. If you're all three, it's just hard to win against you. If you're better and faster, but you're way more expensive, there's just a soft underbelly for somebody to say, great, I'm not quite as good, but I'm on a fraction of the cost. And that's actually going to matter to some part of the customer base that you're trying to win. And so that's how we thought about it. We thought, by the way, on TAM, when I talk about TAM, we were very deliberate in defining our TAM as just quantum of customers that we could reach. We weren't trying to define the TAM as dollars that we could get. I mean, we did that too, but we also were deliberate in trying to shrink the current measured TAM of competitors by driving the price down. And then once we'd won it, by the way, which is what Atlassian had done, we expanded it for ourselves, right? All the money that we left on the table early on was ours to go get later on, which we did. And so that was an intentional strategy. Is we can shrink the TAM by dollar, so there's sort of less market, but we're going to win that market, and then over time we can kind of expand it with all other things that we could sell that customer base and a bunch of other stuff. So that's I think if you have the ability to be ubiquitous, a couple of things. One, if there's hundreds of thousands of companies for you to go get, you have to think about the rate limiter on acquiring them. And if you build a traditional selling model, the rate limiter is how many salespeople can I bring on board and train and build pipeline for and all that sort of stuff. So the rate limiter is just human capital. And then all the complexity of kind of building a system that onboards all that human capital and gets them productive and all that sort of stuff. Pricing is part of that equation, right? Because of if you're super cheap in our particular case, part of what drove the development of our business model is our products were so cheap, just the economics wouldn't support traditional selling. It just wouldn't. Salespeople, you would lose money on every salesperson that you hired, right? Just because the ACVs were in the single digit thousands of dollars. And so the minute that you brought in a bunch of salespeople, you'd be like, man, for us to actually make this math work, we will have to charge a lot more, right? Otherwise, it's just broken. And so that was one way to go, which is what happens a lot of times. Or the other way to go is no, we just have to figure out a different way to distribute our product, to acquire, land and expand customers without that, without that human, selling machinery. And by the way, the thing that we're willing to trade is we're willing to trade lower trade away higher ACVs for lower ACVs. We're willing to trade away higher growth because of this like big valuable enterprise segment that we're not going to monetize in the way that we believe we could, based on the product and based on different things that we can invest. Those are all trades. And so we were willing to trade all that stuff for, for just a different type of business that we were building in the early years that we believed, again, would advantage us in the future from a competitive perspective and from other things. So it's that's how I think about it. To answer your question, like if you've really got the opportunity to be ubiquitous, I just think you need to think about, how am I going to get all of these customers and make the economics worth? And then what are my advantages competitively? And I think if you can square, I am better, I'm faster and I'm cheaper, it's like you've got the trifecta. What else is there?
Yeah, I feel like there's a lot of wisdom to this, and I think it's probably something that maybe not enough startups do. Like, it's a very common refrain to hear people talking about, you should drive your prices up as high as possible, keep doubling your prices until like it really breaks. And there's a lot of ways in which the startup community pushes founders to try to explore the upper bound of what price their market can tolerate. Part of also what's on my mind is sitting here in 2023, when there's been so much venture capital that's gone into the industry, when cost structures have gotten really high because salaries have gotten expensive, and it's just like the cost of like building the software itself in some sense has gotten cheaper, but actually the cost structure that so many companies are sitting on is large enough. Do you think that we're probably in some ways now ripe for a world where a lot of companies can in fact differentiate in these hyper competitive multiplayer vendor markets, where people should be thinking more about looking at their pricing and asking, can we make it cheaper more often?
I do. When there was a lot of venture capital coming into the system, and I became an investor to look for companies that had the opportunity to build business models that were similar to Atlassian's. And by the way, I found a bunch, but I saw a bunch that actually didn't invest that way. I think because there was so much capital where they could basically just spend a lot of money on a traditional selling system, and they weren't necessarily thinking about kind of long-term strategy. It was like, how do I get as fast? How do I grow as fast as possible, as quick as possible? And if that were the goal, I would not build a business model like Atlassian's, because Atlassian's numbers didn't do that, right? It was not a company that did the triple, double. It kind of, it didn't exactly look like a turd because it was sitting off free cash flow. But when you're at 20 or 30 or 40 million of ARR and only growing 50%, that is not a super sexy company by then standards, but certainly by today's standards. And so I think like all of us have been sort of like, trained to think about this certain pattern. And if you don't see that pattern, it's kind of like, it's like, I don't want to dance with that person. Like they're not as attractive as sort of ones that look a certain way.
One quick question on that. Is there any sense in which, even in those years when the revenue wasn't like exploding triple double, was there some metric like number of distinct companies that are getting activated? Was there some sparkle metric inside all of those otherwise bland metrics that maybe a discerning person could have looked and said, oh, something special is happening there? Or was it all kind of just medium?
Well, I think, by the way, the metrics weren't necessarily bland. I think what you had to believe is, first of all, the product had incredibly high NPS. The product was sticky, and so like when we landed a customer, like they stuck with us. The expansion metrics were off the charts, right? Because like you would start so small, and it was so cheap to expand that, the virality of a collaborative product like Jira, where you just invited additional teams and invited additional users, it just, continued to grow. And so those like sparkled, to use your phrase. But then I think you needed to understand that there's just so many, like the rate of new customer acquisition, like the units that we were acquiring was pretty remarkable. It's sort of like, even today Atlassian adds, I don't know, somewhere between 6,000 and 10,000 net new, not gross new, like net new customers a quarter. After 20 years of being in business, it's still acquiring people. And by the way, those are brand new, like never touched an Atlassian product. And you're like, how is that possible? You would appreciate that the company had pricing power. Like it was so affordable that you would believe at any time it's got the opportunity to charge more or to sell more. And its customers are going to look and say, wow, I get so much value for this. Like, what else can you sell me? What else can I buy from you? And that turned out to be true. So I think if you looked at it, that's what you would need to see.
Hey, we'll continue our interview in a moment after a word from our sponsors. Metaview is the AI assistant for interviewing. Metaview completely removes the need for recruiters and hiring managers to take notes during interviews because their AI is designed to take world-class interview notes for you. The result? No more boring note-taking, so you could spend more time on what actually matters, being present with candidates and making high-quality decisions based on insights, not just memory. Metaview remembers everything about every interview, so you and your team don't have to. And unlike humans, Metaview never gets tired and structures its notes perfectly. Because Metaview gives your team perfect notes from every interview, you'll have 10x better hiring data about every candidate you speak with. Team builders at companies like Brex, Robinhood, Quora, and Replit say Metaview has changed the game because it lets them spend more time having high-quality conversations with candidates and less time writing up interview notes. See the magic for yourself for free on your first 5 interviews. Head over to metaview.ai/1000 to get started. That's metaview.ai/1000. I'm a proud investor. Are you finding it time-consuming to hire high-quality remote developers? Pesto Tech is a hiring marketplace that makes finding great remote developers fast and easy. They use large language models to evaluate developers along dozens of parameters, including code quality, performance, and security. All you have to do is answer 5 simple questions on their website, and Pesto Tech will find you world-class remote developers that fit your company's needs. I've heard great things about Pesto Tech from friends like Ryan Hoover, who are investors. So if you need to start hiring developers fast, go to pesto.tech today. That's pesto.tech. If someone was on this call who's a passionate believer in raising prices more than you think, and they were disagreeing with us, what is their disagreement? What do they believe is different from what we believe in terms of why it's important to raise prices more than you think?
Well, I think they can test, the elasticity of a particular price, and you can, you're really testing willingness to pay. And I'm sure willingness to pay can be different than how much market can I go get at a certain price over a certain time period. That's a different thing that I would test for. And so, I'm sure there's lots of examples where people are still winning customers at the same rate as they were after they increased their price by 50%. But they're probably not testing how many more customers could I acquire for myself that I have the future opportunity to grow at a different price point if I lower my price by 50% or by whatever. Marketing is important for lots of things. And sort of in all of my history as a marketer, everything that we did incrementally benefited the business. And so, marketing I always describe as like a game of inches. Once you understand kind of how the levers work, and you've instrumented SEM and SEO and kind of brand campaigns or display ad campaigns, and your event marketing strategy, your PR strategy, and your field marketing strategy, and all of your social marketing, your social strategy. Once you've got it going, unless you're terrible at certain things, the improvements that you'll make in that and the additional energy will be incremental. And this was true of Atlassian too. Anything that we did, it always had this sort of incremental uplift on whatever metric we were trying to move. The only time that we inflected metrics was pricing changes, pricing decreases, right? You could look at 5 years of historical data and you would see this sort of slight uptick of traffic to the web or traffic to trial rates, trial conversion rates, or just absolute trials. It was always just this steady incremental up. When the first time we radically decreased price in the global financial crisis of 2009, it was a step change. It was just like this. And by the way, it shot up and then it plateaued. It was like a new plateau for us in terms of the people that came to Atlassian.com every day that never came before. The people that signed up for a trial that never signed up before. What blew my mind is we had the first kind of pricing change was we went from $1,000 to $10 for 10 users. Pretty big jump, right? And that had this profound impact. When you looked at it, you were like, oh my God, this is just an order of magnitude, more people. It really was an order of magnitude, more people that would just consider us. And we did another big change where we went from basically $10 to free, same effect. And, there's going to be other noise in the system when you bring a bunch of free people in. or even $10 people in. And so it doesn't always sort of flow all the way down into, the ultimate metrics, but just the quantum of people that we could now talk to about what we did. And nothing else that we did in marketing even approached that. It didn't matter. Like we would do crazy stuff. We would spend all this money on billboards and, out of home airport buyouts and all that sort of stuff. And you wouldn't do it. Now you need to do some of those things to basically continue to penetrate market as it gets harder for you to penetrate. But the true inflections in our funnel really only came from pricing and packaging. So that's sort of like the counterpoint that I would give to the person that would say, we've tested our price and we can still win the same customers at 50% higher price. I just think there's more market that you're not seeing.
Yeah, I think this is a good push, and I think it's contrarian in a way it shouldn't be in tech. I feel like you don't hear it enough, so I appreciate it. I'd love to talk a little bit about the idea of being a multi-product company early on, and both building things yourselves or acquiring companies, but just this concept of being multi-product. I think this is something that historically, at least, more commonly, you would see companies wait longer than Atlassian did, certainly, and often I think much longer. I think a lot of great companies even didn't really get into second or third products until tens or even 100 million of revenue. And Atlassian did this really early. This is something I'm particularly interested in because we've done this at Lattice. Also, HubSpot, where you're on the board, is like a really wonderful multi-product company that I would just love to hear your point of view on. How do you think about being a multi-product company and when it's appropriate for a company to do it in its life cycle?
Well, most companies will need a second or a third act, which often involves product portfolio expansion, either built or bought. And it is obviously hard to do. I think most companies that are lost to history and technology didn't do it. They either didn't do it at all or they waited too long. And timing is always tricky because I think you want to do it before your first act has crescendoed. And, because oftentimes it's just going to suck a bunch of energy into trying to rebound that first thing or fix whatever's broken in that first thing. And so all of your kind of tension and energy is there because that first thing matters. You can't give up on it. And so I think there's an argument to say, be thinking about that second act and third act and constructing it in some shape or form while your first act is still on the rise. You don't want to, I just think if you wait too long, it's just hard to say we need to do this other thing because then it's sort of a pivot or, it's a rescue. It's like, well, man, that ship's going down. We need to, build different boats. Multi-product companies just have more inherent complexity. They just do. It's not just having a second thing that you need to care and feed. It's like all of the bits and pieces around, the operating company that need to support it. It's how you think about pricing and packaging and, the priority order of what you land with and what you expand with and, what you cross-sell to which customer, budgeting and goal setting, where all organizational energy is finite. And so the more energy in one thing means less energy in another. It's just the way that it works. And that's usually most acute in budgets and goals. And, because you're going to say, we want this thing to grow a little bit faster, and we're going to give it more to do that. It means this other thing is probably going to have to give something up. And maybe that means it also has to give up something in the goals, that it wants to achieve because it's going to have less resource. Like how you merchandise things, even on the homepage. It's sort of like, how do I talk about these 5 or 6 things? What's the main thing that I talk about here? I want to let people know that I've got a bunch of stuff, but it's not just a phone book they're going to flip through. I've got a purpose and I want to guide them on what matters. And there's a lot of tension in, do I try to load them up with everything that I think will give them value up front? Or do I figure out really what they need right now in the moment and win that one thing? So I, again, preserve a future opportunity to expand them with the others. Those are all really hard. And by the way, they were hard for us. We had this meeting that we called the Hunger Games. And it was basically the prioritization meeting of email marketing messaging into the customer base. because of course everybody wanted to be front and center on that, that message. Like, you've got millions and millions of users that we could tell them what, anything. And sure, we want to use data to get really smart about that, but they may not know what we want them to know. And so like put them in front of the queue. And you've got like, there's so much stuff that competes for that. And so that meeting was this prioritization meeting of what decisions are we making and why. And the reason we called it Hunger Games is because like everybody came in, it's like the trials, like everybody came in and had their agenda, and you'd have to kind of referee what really mattered. And by the way, that was really early on. We got very good at clarifying strategy and like what our land and expand priorities were. But I think all those things are muscles, and it just takes real work to get fitness around them. The more reps you do, like the less that atrophies, or kind of the more fit that system is. And I think the bigger you are, I just believe the harder it is to get real fitness, because there's so much institutional, scar tissue and all sorts of stuff that to build that kind of new thing is hard. And any new thing is just going to be small and potentially inconsequential at the outset. And it's also, by the way, easy to tax those new things with all of the organizational carry, of that first product. And that's what I've seen be really hard. And I think like we had an advantage of where we did it really young. And so we were just a tiny little company that started the second thing. And so there wasn't too much energy to compete with. And then there were two things. And like, once we built the rhythm of having two things, adding, if it's like kind of like having kids, right? Like once you've been through two kids, then, the kind of the joys and the nightmare. Yeah. Like the nightmare of like feeding schedules and not getting any sleep and all that sort of stuff. Like the second one is like, oh, it's a little bit easier. The third, it just raises itself pretty much. By the way, HubSpot did it very differently, where they basically wanted to build this second thing, which is basically the sales product. But I think in a really clever way, they put that new product team in their own building. It's like almost completely isolated from HubSpot core at the time, the marketing product. And they built the sales hub and the sales product that way, where they really wanted that team to be first principles oriented and not even be able to draft off of all the other stuff. It's like you on your own need to kind of build this thing. And when it got to a certain size or scale, they kind of brought it back and integrated it.
Yeah, I mean, I guess with that HubSpot product, I guess it was deep at the level of not just another application, but HubSpot was really going from, in my understanding, applications to really building like a database level platform CRM, which is just so substantial of a move that you almost need a different whole DNA, I imagine, to do that.
Yeah.
On the topic of building muscles, which I completely agree with, that like organizations kind of they institutionally create muscles. Atlassian, I think you mentioned to me at some point that you did like 17 acquisitions in 20 years, some like large number of acquisitions that very few startups end up doing. And you end up, of course, I'm sure with that really, by the fourth or fifth acquisition, you're like, all right, we know what we're doing here, versus the first one is hard and, different and whatever. So I'm curious your reflection on acquisitions. Is this something that you feel like was super important for Atlassian? Did it do things besides just acquiring the product, where it sort of drove, operational rigor for the company because you had to have it to ingest these companies? What are your reflections looking back on such a high volume of acquisitions for a company?
Sure, we got better the more we did, but also the bar gets higher, right? The bigger you are, the bigger, the company that you're acquiring probably is. And that makes it, a different degree of complexity that you've never faced before. But you've got some prior art where you're like, we learned this lesson with the smaller one. This will be different with this bigger one, but we learned some things that we can kind of apply to this context, and then you just have to like kind of figure it out along the way. And we would take kind of learnings from what did we get right? What did we get wrong? How do we apply the things into a bigger, more complicated context that makes sense? And then what do we need to just figure out in the moment to make it work? Part of what we were good at is we were good at understanding that sort of that broadening product portfolio and pricing and packaging harmonization, and like how you take things to market and how you reach the customer base, and how we think about kind of the priority order of what goes where and when. That's what we got really good at, which and we had a system for it. So when we brought a new thing in, we knew how to integrate it into that system. And then, I would say like a couple other things we learned along the way that were valuable. Like when we acquired Trello, and this is one that, I share with companies to think about, because we were maybe 1,500, 2,000 people at the time, and they were a couple hundred. And, but big enough where they had things that they really cared about. They had a great culture, and, there were traditions and sort of like, little special parts of their culture that mattered to them. And we were, our all hands meetings, we called all hands, and they called theirs town halls. And it was symbolic, but it was genuine and meaningful. Like we rebranded our all hands meetings to town halls. And, I think for them, it was like, oh, wow, that's not something that they needed to do, but it was sort of a touchstone for them. And it was an example of us saying, we care about you being a part of us so much that we're willing to kind of change this part of our own architecture to have it be more familiar to you. But they were a remote first company, and, we were a very distributed company, but, we adopted a bunch of their learnings around remote collaboration. So things that everybody does now, where it's like, if you've got a couple people in a room and a bunch of people that are at home, everybody basically goes on Zoom, so we're all even. Nobody's disadvantaged by not being in a room. And we began to do that, like even at a management level. I think and everyone is a different learning situation. It's, like we made a lot of smaller technology company and smaller technology acquisitions, and then a couple of meaningful big products along the way. So it was a pretty interesting mix.
When you look back, given that you've done so many on the acquisitions themselves, and when you look back at, hey, maybe ones you missed that you should have acquired that you didn't get to for whatever reason, or ones that you did, but maybe you paid too much or whatever, wasn't the right fit. Was there any part of your criteria that you refined over time, or any lessons worth sharing with the founders listening?
I mean, we cared a lot about strategy alignment. Like, you have to, you really have to believe, especially if you want this to work, if you want the combination to produce more than the thing could individually, or any part of both companies could do individually. You have to be aligned on what you're going to do. And so that's a lesson that we learned along the way, and just making sure that alignment is true up front. And yeah, there's dollars and cents and kind of economics downstream that kind of matter to people, but the thing that we're actually trying to accomplish needs to be shared. And that's sort of one. We needed business model alignment. I mean, it wouldn't make a lot of sense for Atlassian to acquire something that was had ACVs of $1 million, and even though in the end, once we kind of like turned on our enterprise business, we acquired a company called AgileCraft that really just sells into the global 2K, and it was something that our customers needed that complemented where we were in a really logical way. And by then, we'd added enterprise selling features to the business model. And so, but early on, that wouldn't have made sense, just because it would have been an impedance mismatch with like how we operated and what we were trying to do, to have this other thing that was trying to do something really different. We ended up like harmonizing kind of business models, I think, pretty effectively. Like, I'll give you an example. Like, we had, we acquired companies that had selling teams. And part of our business model, part of the tenets of our business model was we don't discount and we don't negotiate terms and conditions. And it's just what we do. So even if we're going to have sellers, we are not discounting and negotiating contracts any longer. That's just like not the way our business model works. And by the way, we've proven that that works for us. And so we believe it'll work for this acquisition company. Of course, like that met from selling teams, that met with a lot of resistance. It's like, oh, you can't, like if I'm not allowed to discount or not allowed to negotiate these terms and conditions, I won't win the business that you need me to win. And almost like I think in every case, we would say, like, look at what does the math say the average discount is? Let's just make that the new price, and then you won't need to discount. Like, I mean, that's part of let's just take the price down to what you're discounting to, publish that as the already discounted price for everybody, and then you don't need to discount further. And then most of the customers, like, they'd already agreed to terms and conditions that we hadn't had to negotiate. And so, like, we're just going to hard line it's done. The businesses weren't harmed. In fact, they picked up velocity, so it's like, and that was, I think, just sticking to our guns on, like, we've proven these things work and we think they can work in this shared context. And so, we'll make it work.
Those are great lessons. Maybe one last question, just with our last couple minutes. Switching gears over to HubSpot, where you're on the board. This is like one of the companies I most look up to in software today, and it's an amazing company on so many levels. But one question that I was curious to ask you about. It's thousands of employees. It's like getting close to a couple decades in. And the talent that the company has and the culture the company has seems to me really unique. Like I frequently will meet somebody who works at HubSpot, has been there for 7 years or 9 years or 12 years, loves the company, is whip smart, really cares. And I'm curious how it is working at this scale to still feel like that, because it strikes me as so uncommon to be 7,000 employees or whatever HubSpot is and still have that level of employee magic. And I'm curious if there's anything you've observed from a board level or what seems to make it tick that way.
I mean, culture matters, and culture requires like intention and effort, and things that you do well and things you don't do well that you fix, and that they've just been very deliberate from an early age. I think if you don't start it at an early age, it's tough to course correct after that. Your culture kind of is what it is, and by the way, that comes from founders. It comes from Brian and Dharmesh at a really early age, and the type of company that you want to build came from Mike and Scott. It comes from you at Lattice, and so I think it kind of starts there. But then it's also it's also how that intention and being deliberate takes shape. And so they have a deck that's public called Culture Code, which talks a lot about this. And one of the things that they talk about that resonates with me is they treat culture as a product. And by the way, like we treated our business model at Atlassian like, I think everything inside of a business is like, think of it as a product. Like you ship an MVP and it may be missing a bunch of stuff that you're going to have to add to it over time. And then, naturally the product that you ship, your culture product that you ship when you're 10 people is going to have to be very different when you're 1,000 people or 10,000 people. And so you're constantly going to have to like figure out what features do we take away because they no longer make sense or they're not being used, or what features do we need to rebuild just because like they haven't scaled or evolved? What features do we need to add? And we thought about our business model, by the way, like very similar. We're like, the business model is a product, and like adding enterprise salespeople is a feature that that we may not need to add when we're at 50 million. We'll probably need to add when we're at 500 million. Like, well, what does that look like? And I think they've treated their culture as a product and done that. And the other thing they say that resonated a lot with me is any company is building two products, probably at three if you think about your business model. But you're building a product for your customers, and then you're building a different product for your employees. And it's just that idea that this is a product that we're going to like care and feed and shape and change and evolve, because we want this place to be the best place that it can be for the quantum of people that are in it with us, building everything for our customers. And then I think the other thing I would say is you have to walk the walk. It can't just be slide decks and cleverly worded values and things like that. Companies, if they don't have leadership and people that do the things that on the paper that they say they do, it's just very hollow, and you won't meet the type of people that you said you meet. But I think if you really follow all the way through, that is the best recruiting system in the world is treating people well, like creating the system where you're going to be able to do good work, and that you're going to treat people with respect and dignity and honor and integrity, and give them a chance to do the best work of their life. Like if that's the system that you're building and you actually like are fulfilling that, people will stay and people will come. And that's, by the way, I think Atlassian, it also worked really hard at that and cared a lot about its culture. And I was able to participate in that for 12 years, but both companies are very similar in just being intentional about what they're building.
I think that's an inspiring note to wrap on. Jay, thanks so much for coming to the podcast and sharing your hard-earned wisdom and lessons with us.
Yeah, fun, guys.